David, I'll start with you. Your response to some of those comments at Davos.
We've always been of the view that the growth rate we saw in 2018 was really driven by fiscal stimulus. And we always expected that, particularly in the U.S., growth would gradually come back down to earth as we moved into 2019. But I think what's important to recognize is that right now this is just a slowdown. This is not a stall out. And I think what we need to focus on as investors is what happens with corporate profits, right? 70% of the U.S. economy is based on consumption. The way you end up with a recession is when consumers retrench, they stop spending. That doesn't happen until people start getting laid off. So I think keeping one eye on the labor market, obviously keeping an eye on the Fed will be important as well. But I really view this as kind of a return to normalcy rather than the beginning of a broader kind of pullback in the U.S. economy.
Brian, where do you stand on this?
Well, as we've gone around and talked to clients around the world, we were in Europe last week, it seems like people are wishing for a recession. The way that people are positioned. And what we saw in December with respect to the markets, it was almost like we had a buyer strike. I mean, it was a buyer strike. No one wanted to believe in the whole system of investing anymore, especially when buy the dip didn't work into December. So I think people are wishing for a recession. What's really interesting, though, is that people say recession, but they can't really define it, right? Can't really define it. We have three types of recession: a capex recession, a credit recession, and a consumer recession. Well, the consumer remains very strong with gasoline prices under $2 a gallon on average. Consumer spending from a personal consumption expenditure basis still looks strong. From a capex cycle, we haven't added any capex, so how are we going to have that? And from a credit perspective, credit spreads have expanded, but nowhere near what we saw in 2008, 2009. In fact, the credit spread expansion is well below the long-term average. So again, we don't think there's a recession on for several more quarters. And I think, again, people are trying to will the market lower again because they missed the rally once again on the recovery, and they're bitter.
Well, I mean, beyond just wishing for lower prices, Brian, I mean, I do think the question is, what have we proven in January except that the panic was so extreme in December, right? You've reversed that. I don't think it's easy to make the case, is it, right now that the market is priced for any significant decline in corporate earnings? What do you think right now for 2019 is built into U.S. stock prices?
Well, Mike, it's a really good question, and here's what we would say. We just put out a note minutes before we came on the broadcast, and if you take a look at deciles, and not only in terms of valuation but beta, it's really interesting. It's not just that the stocks that were hit the most have gone up the most. If you actually do the work and look at valuation, you'll see the three lowest deciles in terms of next 12-month PEs are the best performing stocks off the lows, where value has been a discipline that has been decimated in the last couple of years. And the highest actual decile of PEs actually came back as well. So you have fear on the tech side and loathing on the financial side really leading this uptrend. I think the market coming into this year was priced for a recession and priced for, let's say, 3 to 4% earnings growth. We think the number is going to be somewhere between 6 and 8% earnings growth. So close your eyes and just imagine 6 to 8% earnings growth, 2% GDP, 3% 10-year treasuries. That's a pretty darn good place to be with respect to owning stocks under that environment.
David, one of the key questions here, if you're seeing slowing economic growth, both globally and potentially domestically, what does that mean in terms of the Fed and other central bank policies?
So I think that that's the key question, because when you talk about an economy which is still growing and you talk about earnings growth of, call it 6, 7%, wherever you shake out relative to consensus, the question for investors is what multiple do you put on that? And I think the multiple that gets put on that is directly tied to what happens with the Federal Reserve. I've been thinking about this kind of impossible trinity for investors this year, where what investors really want to see is solid economic growth, resolution on trade, and a Fed which sits on the sidelines. Unfortunately, I don't think all three of those can happen at once. If you have solid growth and resolution on trade, the Fed's going to hike rates. So I'm not sure how much more the multiple can really rise on the S&P. Maybe you get a little bit in addition to that. We're already up.
2 out of 3 ain't bad.
But 2 out of 3 ain't bad. And we're already up 6.5% this year. You go back a few weeks, you had a lot of people calling for mid-single-digit returns for the year as a whole. So I think we've definitely seen a nice bounce back here. Now it comes down to policy. What happens with China and trade? What happens with the government shutdown? What happens with the Fed? Those are the key things I think to keep your eye on.
And how wide is that lane between too slow and good growth, but the Fed doesn't really choke it off?
So the Fed is in a unique position this year because we actually think inflation is going to remain relatively soft given the re-rating we've seen in oil prices. So the Fed can use that as cover to stay on hold. But if you see 2.5% economic growth, if you see a stock market where multiples expand, back above the long-term average, we know that was giving Jay Powell some pause in advance of the sell-off late last year. And I think you will see them continue to hike rates. I don't think you can dismiss the potential for 2 rate hikes this year out of the Fed.
Brian, how should investors be positioned right now, given the fact that we have seen the rally this month that we have seen?
Well, strongest rally that we've seen in January to start the year since 1989. What David just talked about was basically Goldilocks and the 3 bears. And given the fact that the rest of the world has fundamental volatility, we think investors around the world will become reluctant buyers of U.S. stocks. I'm kind of growing tired and bored of everyone talking about high quality. Here's what you need to buy. You need to buy those assets that provide earnings stability. Technology is the most stable earner in the S&P 500, and financials are the most feared and loathed and hated sector in the world. We think that big recovery with respect to financials is just beginning. And we also like communication services, healthcare, and industrials, especially industrials with a trade impasse coming to the end, and a massive re-rating on a short-term basis coming within that sector.